Welcome to the chapter 6, Charlie Munger Stock Basics. In this chapter, there are four main objectives that we are going to learn. The first one is the Charlie Munger's four rule for buying stocks. The second one is Charlie Munger's valuation technique. The third one is Charlie Munger's opinion on the market. And the last one is the patience and the individuality. So let's get started. This lesson is just a quick and a brief overview of the fundamentals of Charlie Munger, Warren Buffett, and Monish Pabrai kind of investors. Now, as you go throughout the rest of the chapters, you are going to get a lot more information on all the stuffs that's contained in this short chapter. What I am going to start off with this is Charlie Munger is a person who likes simple things. He likes to focus on fundamentals. He does not like to get down in the trash on certain things. He likes to look at the things from a very simplistic viewpoint. And so he has four rules that he uses for investing in the stocks. So the first rule is that the stock has to be stable and understandable. For a lot of people, they are kind of attracted to a stock that might be volatile because it might have huge rewards in the end, even though there is a lot of risk associated with it. The reason Charlie Munger is not attracted to this stock because he knows that a stable and understandable stock is something that he can actually calculate. So when the company is producing the same earnings year in and year out and they consistently grow their equity at 10% a year or whatever the case might be, he can predict what the company is going to be worth next year, the year after that. And so, one of his four rules that he absolutely sticks to is that he never invests in a company that he does not determine, that is stable and something that he can understand. So, the second rule is that a stock must have a long term prospect. What I mean by that is he is not investing in a company that sells TV antennas. He is the type of person that looks at a company and says, this is the company going to be around 30 to 40 years from now, and their products still going to be something that the world still needs in that duration of time. The reason he does is because he likes to buy a company and hold it, because when he holds it, the growth of the company is actually happening in the market price, and then he never pays any taxes on that growth. So really the long term prospects is something that really is wrapped up into taxes, and we are going to cover this a whole lot more in the future chapters. That's the second rule that he always follows whenever he buys a stock. The third one is a little bit harder to assess as a small investor, not a large investor like Charlie Munger, and that is a stock must be managed by vigilant leaders. Now, one of the things that I roll up into this tenant is that the company has to be managed by individuals that manage debt well. So, one of the things I really stay away from, and then Charlie Munger really stays away from, is any company that has a lot of debt. I kind of roll that up under this rule so that for us it's little hard as a standard investor. That's not worth that. It's kind of hard to go in there and have a meeting with the CEO of the company and determine whether he is an ethical person that you would or you wouldn't mind owning part of his business. So that's the third rule. The fourth rule that we have is that Charlie Munger never buys a stock that is overvalued, must buy stock that's undervalued. So what he does is he goes in and I like I said before, he determines what he thinks the intrinsic value of a stock is. And so if he determines that the stock is worth $50, he always going to try to buy that stock for under what he determined the value to be. Let's say $40 is what he would be comfortable buying the stock for. He is never going to overpay for that. So the name of the game really comes down to is finding that intrinsic value, and that's the fourth tenant. Now I would like to say that each of these four rules all have to be met. He never goes out and says, well, rule number 3 and 4 is met, so I will buy this company. He never does that. He always ensures that all four of these rules are always met, or he never buys the company. And I would recommend that you do the same thing because it really works out well. So let's take a quick at rule number 4, where a stock must be undervalued. I'm going to teach you a little trick that Charlie Munger did whenever he worked for Benjamin Graham for a few years. And this is really interesting and a quick, easy way to kind of pick through companies that are worth investigating further and the companies that are not worth. So, when we looked at the last four chapters 1 to 4, we learned that the market price, the earnings, and the book value are three very important terms. And what Charlie Munger and the Benjamin Graham did is they tied all three of these terms together in a quick way to kind of assess a company. So, when we looked at John's coffee shop business from the previous chapters, we took his coffee shop and we divided it up into 10,000 shares, outstanding shares. When we did that, we found out that the market price for one share, because he was asking $100,000 for the business, that the market price he was asking for the business was $10 per share. We saw that his net income was $20,000. When we divided that by 10,000 shares, his earnings ended up being $2 per share. And then $10,000 in equity that he had off of his business balance sheet, when we divided that by 10,000, which gave us $1 in book value. So these were the really important terms that we learned in the first four chapters. And what Charlie Munger does with this quick little evaluation tool that I'm going to teach you here is he wraps all three of those terms into one quick assessment for a company. And so what we are going to do is look at the earnings there that tells us our potential returns, which is $2, and you are going to take that and combine it with your book value, which is $1, which is your assessment of the margin of safety, and you are going to get a quick and easy way to assess the company. So I move to the next slide here, as you see on the screen. As we look, I am going to start off with the earnings. So that was the middle number, earnings $2. So the earnings here, I am just going to show you. We talked about the price to earnings ratio in one of the previous chapters. And what the price to earnings ratio is doing is we are taking the price and we are looking at the earnings. The price is $10 and the earning is $2. And all you are doing is you are just dividing those terms. Taking the price divided by the earnings, which is 10 divided by 2, that gives you a ratio of 5. As you learned in the previous lesson, the way that you look at the ratio is you say this saying, for every $5 I am going to spend buying this business, I can expect $1 in return 1 year later. And so when we see the P of 5, that's what it really means. Let's assume all those earnings go into your pocket. That's going to give you 20% return. And all the only way you have got to figure that out is just take $2 and earnings divided by the market price $10, and that's 20%. So what I want to do is I want to show you when you go on to a Yahoo website and look for a company, when you see the PE is equal to 25, as we move to the chart on the right, you see when the PE is 25, that's actually giving you a 4% return. And that's assuming if the company can turn all the earnings into the money that's actually going to be realized into your pocket. The best you are going to do is 4% with a PE of 25. Now, when you look at the P of 20, your return goes to 5%. And as you go clear down to the P of 5, which is the one that we had for John's coffee shop business, the return actually goes to 20%, which is pretty high. Now, the thing you got to realize is when P is really low like that, then your return is really high. What you can expect on the margin of safety is that your margin of safety is going to get worse. We just looked at the price to earnings. Now let's look at the price to the book value. This is a ratio that we have not looked at yet. It's called the price to the book value ratio. Okay. So we are pretty much doing the same thing that we did with the PE ratio. Now we are taking the price, which is $10, and we are dividing it by the book value. And when we do that, you come up with a ratio. And so if you look there, we are taking $10 divided by $1. That gives us a ratio of 10. Okay. So, what in the world is 10 mean? Well, if you go back, kind of similar phrase we said before. Every $10 you spend buying this company, you are going to have $1 of equity in the business. So that's not very good, isn't it? Just just like the PE, the lower the number you go on this, the better it is for you because you have more safety on your investment. So let's go ahead and look at the price to the book value compared to the safety here. So if you had a company that had a price to book value of 5 on the ratio, that means only 20% of what you are buying that company for, let's say it was a $100,000 business, only $20,000 is going to be on the equity in the business. So if you bought it for $100,000 and you needed to end the business today, you would only get $20,000. So as you go down the chart, those numbers through 3, 2, 1, and then 1.5, and then you have zero point 0.7, you can see how that safety changes. The price to book value when it is 1, that means if you buy the business today, okay, let's say you buy the business for $100,000, and if you sell the business immediately after you bought it, you could liquidate the business and get $100,000. That's what the price to book value of 1 means. Now, the price to book of zero point 0.7 means you could actually buy the business, buy all those shares, end the business, and actually make money because the book value is actually more valuable than the price that you bought it for. And believe it or not, there are actually companies in the book stock market that trade like that. Just like we learned in the last slide, when the price to book is that low, guess what? Earnings are probably really bad. So there is your trade off. When the price to book is really low, your earnings are probably going to be really bad. And when the earnings are really good, the price to book is going to be really bad. So that's your trade off. So what I have done is on the left hand side of this slide are the P ratios. That's our price in our earnings. And then on the right hand side, we have the price to the book value. We know that the earnings talk about the return we are going to get on our money. And we know that the book value talks about the safety that's involved with the investment. So what Charlie Munger did is, this is back before they had internet. They had these really big books, and in these books they had all these ratios and the prices for all kinds of different stocks that were trading on the New York Stock Exchange. So what Charlie Munger would do is he would go down through all the columns of these books because they are really big. This book was huge, and he would read through the book and he would see a ticker or a company name, and then he would see the trading price, he would see the PE ratio, he would see the price to book ratio, and then a quick way that he would determine whether it was a company that he wanted to go after or not. He would find the PE that was low, and he would look at the book value that was low. And as you look through this, the PE that he was really focusing on and was trying to find a business that had a PE of 15 or lower. As you can see in the slide, I have highlighted that the 15 and lower is what he was really going after. So he was looking for a return of something that was better than 6.6% is what he was looking for. Then over on the price to book, which is our safety net, he would try to always find a company that had a price to book that was better or lower than 1.5, because you can see that's where all your safety is. So he came up with a great idea. Well, if you are always trying to find a company that has a PE below 15, and we are also trying to find a company that has the price to book value below 1.5, why don't we just take those two numbers and multiply them together? And if we multiply the 15 times the 1.5, that equals to 2.5. So what he said is, I'm going to look at this big book of all these ratios and terms. I can quickly assess whether a company is something I'm interested in by taking the PE and multiplying it times the price to book. And if the number comes out below 22.5, this is probably some company that I really want to take a closer look at. And the reason that he was doing this is because, as you can see here, the little triangle in the middle that I have, that compares the price to the earnings to the book value. That incorporates all the variables that we're really concerned with. We are concerned about what price are we buying this thing at, what do we think the return is going to be, and how much safety is involved with this investment. And all of those terms are wrapped up into just taking the PE and multiplying it times the price to book and making sure that the number is below 22.5. So that's a really quick and easy tool that Charlie Munger used to do. He would go through all these big books and actually try to find companies that were below the 22.5. Now, as we go further along in this course, you are going to find out that valuations get a lot more complex than this little simple model. But if you want to go out and try this with real companies right now, I think you will find that it actually gives you some really good picks of company. For such a short and easy assessment of just taking two ratios and multiplying them together and seeing if the numbers is below 22.5. Okay. So I just did this real quick with John's coffee shop business. If you remember, the PE for John's coffee shop business was 5, and then his price to book was 10. And so what I did is I took the 5 times the 10, that equals 50. So you can see that if you were going to try to run John's coffee shop business through Charlie Munger's little tool here, his valuation tool, he would have missed the mark by a lot. He was way overvalued valued because we want the number to be below 22.5, but he was at 50 point. Okay. Charlie Munger always looks at the market itself is nothing more than something that can facilitate him buying companies at lower price. His opinion in the market goes into rule number 4, which is that a stock must be undervalued. He uses the market to his advantage as opposed to something that he is scared of. So he has the opinion, and this is his quote. I buy on the assumption that the stock market could close tomorrow and not reopen for another 5 years. That's how he looks at it. When he buys that company, he truly plans on owning that company forever and that those shares forever, because he is buying it based on the assumption that I am buying this company is going to give me a 10 to 15% return based off of what I am buying, and there is no reason why I want to sell a company that's paying me that kind of return. So he could care less what it does on the day to day. All he is doing is he is going to look at what he thinks a company is worth, and if the market is offering him a price that's much lower than what he thinks it's worth, well, then he buys it. The overall view that he has at the market is that some days you will get offered great buys, I mean deals, and the other days you will get offered horrible deals. But your job is to know when it's a bad deal and that you don't take it. The last thing I want to talk about is Charlie Munger's opinion on patience and individuality. So his opinion on the patience is that there is no way you are going to be a successful trader unless you absolutely positively have patience and that you stick to your fundamentals. When the person goes out there and they are trying to find the company that's going to give double or triple their money in 3 months, unfortunately for that person, I just don't think that they are going to have much success in the long run. You have to be very patient person who is happy with making 10 to 15% returns on your money, and if you can do that consistently, you are probably going to be very successful in the long run. The other thing that the Charlie Munger is really big fan is thinking for yourself. I can't stress this enough. Don't ever base your stock investing off of your people's opinions. When you do that, you are probably going to find yourself in trouble. Remember, right now, February 2023, market is really low, and for me, I am extremely excited because I can buy companies at just unbelievable values, and that had almost no depth. I can see many people just screaming bloody murder, bloody bath, bloodbath in the Wall Street. Whole economy is under collapse, and that's the world is going to end, etc., etc. So, but this is the time to be buying great companies. Same thing applies whenever the stock market is doing really good, and you go to your work and you hear everyone around you talking about what they are buying. The stock market is really doing good. Oh, so great. And that's probably a really good indicator that you probably should not be buying stocks. I found out that if I am doing what everyone else is doing, I most probably doing something wrong. So that's something that I would recommend to you, that as you get out there and you start getting more involved in the stock market, if you are doing what everyone else is doing and talking, you probably falling into the trap that you might not be doing things right. So always think for yourself. conduct your own valuations on what you think the companies are worth, and then go to the market and see if the market is offering you a decent price for that value that you think it is worth. So, in this chapter, we discussed 4 different lesson objectives. The first lesson objective was to learn Charlie Munger's 4 rules for buying stocks. Second was to discuss a real basic valuation technique that Charlie Munger used. And the third was the Charlie Munger's opinion on the market. And the fourth was understanding Charlie Munger's opinion on patience and individuality. So, I hope you learned a lot here in this chapter, and I look forward to working with you guys in the next sessions. Thank you very much.